I present this video for those of you fascinated by the concept of index funds and interested in knowing the history of index funds, thereby understanding the implications of indexing in our financial lives. While many of you are aware that any discussion on index funds is rendered useless without the mention of the pioneer, Mr. John C Bogle. The actual history of index funds dates back to 1955, way before John C Bogle. In 1955, Edward Renshaw and Paul Feldstein published a famous paper called The Case for an Unmanaged Investment Company, which should give us a pretty insight into the mutual fund industry of USA back then from the years of 1940. Here is a summary of that paper. The first point they made was that there was a rapid growth in the institutional investment in American businesses since 1940 to 55. There was a rapid growth, agreed, but no one seriously ever questioned the basic axioms that professional advice and continued supervision are worth their price. The second point they put forth in that paper is that over long periods, the investor would have been better off on an average investment in Dow Jones Industrial Index rather than to have picked an actively managed investment company. He concluded this point based on data from three sources. One is the Security Exchange Commission, the second is American Institute for Economic Research, and the third one is Arthur Weisenberger. He concluded that the average investor would be better off if a representative market average were followed instead of an actively managed fund. But this strategy has not gained prominence because the investor is always captivated with a false notion that an actively managed fund will always perform better than the market average. Note that at the time of publishing this paper back in 1950s, there were no terms like actively managed and passively managed funds. Instead, the terms they used were managed funds and unmanaged funds. Managed funds meaning the active funds, unmanaged funds meaning the passive funds which just follow the index. But as we know, truth is never accepted all at once. It faces a lot of resistance. This paper faced criticism just few months later by a Bloomberg columnist in an article called The Myth of the Rational Market, where he criticized that this idea is sophisticated yet impractical and doomed to fail because tracking index real time without incurring significant costs is impossible. Later, in 1960, a person named John B. Armstrong released an article titled The Case for Mutual Fund Management, where he explained a point that certain leading mutual funds could beat the Dow Jones averages. He criticized the idea that an unmanaged portfolio would do better. In short, he was against an unmanaged index fund. Let me give you a surprising fact. This person, John B. Armstrong, is none other than the famous Jack Bogle. the founder of Vanguard. John Armstrong was his pen name. Isn't this surprising? Because it is the same person, Mr. Jack Bogle, who later became a major proponent of index funds. But back then in 1950s, Jack Bogle was supporting the active fund management idea in his article. It is because early in his career he was a rising executive at Wellington Management Company in the 50s and 60s. Probably his young blood back then did not accept a passive management. Later, Bogle rose to prominence at the Wellington Company during those aggressive go-go years of 1960s, which was labeled as a new era for the stock market. At this time of 1960s, in fact, the stocks were driven by illusion and speculation rather than fundamentals. He was so aggressive and engineered a merger deal with a Boston firm which was managing the hottest go-go firm at that time. The merger initially worked out very well for both the companies. The young and brilliant Mr. Bogle was promoted to the apex of his career as the CEO of Wellington. But this situation didn't last long. By the early 1970s, the go-go years blew out and plunged down the profits. Remember reversion to mean in John Bogle's book? In short, what goes up must come down, isn't it? This decline in profits gave rise to many hostilities within the company, and Bogle was fired as a CEO in 1974. But Mr. Bogle, a strong man himself, is determined to lift himself up. He convinced the company to form a new company in 1975 to handle only the back office operations under his leadership. This company was named Vanguard. This company in the beginning used to handle the day-to-day administrative activities, financial and legal aspects of Wellington. But it was strictly not allowed to research, manage or distribute the mutual funds. Then he began to introspect his ideas of active management. An avid reader himself, he got inspired by the works of great people like Paul Samuelson. He now has more data to dig into about the mutual fund industry than back then in 1960s when he wrote that article. Now, he calculated the annual returns generated by dozens of actively managed US equity mutual funds for the previous 30 years. He then compared the performance of each of these funds with the S&P 500 index, which is a broad measure of large US companies. His analysis showed that active funds underperformed the S&P 500 on an annual pre-tax margin by 1.5%. He found that this shortfall, that is the 1.5% difference, was because of the costs incurred by the fund investors. That's when the aha moment happened, a revolutionary idea that became the lifelong history and destiny of the Bogle and Vanguard company, that is the index fund. With just few members on board, he created a proposal for an index fund. He convinced the Wellington Board of Directors about the index fund and a declaration for Vanguard's first index investment trust was filed with the US Securities and Exchange Commission in December of 1975. The official launch of the world's first index mutual fund happened in 1976 August. Though there were some index funds in the past for institutional investors, the first index fund for an individual investor is definitely the Vanguard Index Fund. At first, the fund grew very slowly with very little fan base, fewer assets. Bogle was ridiculed by the fund industry. But later, with a raging bull market in 1983, the fund's assets climbed exponentially. The good word of indexing spread, and the rest is history. As Mr. Bogle said, if he had not been fired as Wellington CEO, there would not have been an aha moment and a Vanguard index fund. He made the mistake of trying to actively beat the market. Even the most successful investors make money mistakes, including Mr. John Bogle. But the whole world of investing will thank him for this big mistake and realizing the value of an index fund. His life is filled with success, failure, hope, dream, and everything in between. Today, Jack Bogle has greater impact on the average investor than anyone who has ever lived. Long live Mr. Bogle. Today, Vanguard, the world's largest mutual fund company, manages around $5 trillion in assets. The lesson for all of us here is that don't go back and forth between picking stocks, buying options, timing the market, and trying to be a successful investor. Stop looking at the articles like Top 10 Mutual Funds, Hot Stocks of 2021, etc. Instead, have a share of all the big enterprises of India by buying an index fund and holding on to it. This is the secret that the whole mutual fund industry and their marketing team doesn't want you to know. If they tell you there is no such thing as the best fund at all, they don't have any business. All their 5-star and 3-star ratings will no longer be needed, and they will be out of jobs. They like to make things complicated by those fancy P/E ratios, bull market decisions, bear market trends, stop losses, target prices, and they try to sell you a point that they are smarter than others. And if you follow them, you will gain few extra bucks. That is what they try to sell you. But we need to realize that markets are much smarter than them, and there is something called as reversion to mean. And we always need to rely on consistent average returns rather than fancy, exaggerated short-term returns. If there is any data that doesn't prove that indexing wins, the data are wrong. It's amazing how difficult it is for a man to understand this very truth of the life if he is paid a small fortune of short-term gains so that he will not understand the real truth behind it. Coming back to our Indian scenario, IDBI principle was the first AMC to embrace the concept of indexing and launch a NIFTY Index fund in India. The scheme later became NIFTY 100 Equal Weight Fund. Today, the biggest mutual fund in India is of course an index fund, the SBI NIFTY Index Fund. The concept of mutual funds and in fact index funds is pretty new to India compared to USA. The first index fund was launched in 2000. I hope this video was helpful to you in understanding the history of mutual funds and the real-time implications of understanding the concept of indexing.